So we've looked at one method to compute the cross rates. Now let's look at another method to compute the cross rate so we get a better idea of the perspective of the market maker and the price taker. Now when you look at the currency pairs quoted in the market, you see that they are quoted using the bid and ask rate. We have already mentioned that the bid rate is the rate at which the market maker buys, and the ask rate is the rate at which the dealer sells, the market maker sells. So another way to construct the bid-ask rate of a cross-currency pair is by using the bid and ask spreads quoted for each pair in the market and derive the rate for the cross pair. So let's take an example of the Euro Canadian to understand what we mean by this. So we look at the Euro rate, which is 1.098789, and we look at the Canadian rate, which is 1.363032. In order to construct the bid rate for the Euro Canadian, which is the rate at which the market maker buys, so that is buy Euro and sell Canadian at an X rate, we would need to know at what rate we can sell Euro and buy Canadian to square our position in the foreign exchange market. So if I'm long Euro and short Canadian, I would need to sell that in the market, and therefore I would need to sell the Euro and buy the Canadian to square my position. To take a simpler example, if I'm bidding for a kilo of potatoes to resell in the market immediately, I would need to know at what rate I can resell it in the market and accordingly bid lower than that price. That would form my bid price. Similarly, I would need to know at what rate I can sell the Euro for in the market against the Canadian in order to buy lower than that price. So if the trader is long Euro and short Canadian, he would need to work out the rate at which he can sell the Euro and buy the Canadian in order to square his position. If the Euro CAD price were readily available, he would be able to sell it at the bid rate in the market, since the dealer now becomes the price taker selling at that bid rate. However, since the price is not readily available, he would need to reconstruct the price in two steps. He would need to sell the Euro by the US dollar, which we can do at the bid rate for the Euro USD, which is 1.0987. Since now the market maker is a price taker, he would need to sell at the bid price in the market, and he would then be long dollars, so he would need to sell the dollars and buy the Canadian. And he can do that at the USD CAD bid rate, which is 1.3630. And in effect, he gets the rate of 1.0987 into 1.3630, which is 1.4975. Now this becomes the ceiling for our bid price. If we bid anything higher than this price, we would make a loss at the current market rate. So let's assume that if our bid price was 1.4977, we would buy at 1.4977. However, if we were to square our position, we would only get 1.4975, which would be a 2 pip loss, and therefore we could only buy at 1.4975 or lower than that rate. Now similarly, we can price the ask rate. If you can pause the video and derive the ask rate for the Euro Canadian in a similar fashion, then you would get an idea of how to price the cross rates. Okay, so to derive the ask rate, the rate at which we can sell EUR-CAD to the price taker, we can break this down into two steps. The process is very similar to deriving the bid rate. If we sell Euro and buy CAD, to the price taker, we would need to cover the euro short position and the Canadian long position. So in order to cover the euro short position and the Canadian long position, we would need to buy euro and sell Canadian. In order to buy euro and sell Canadian, we would need to buy euro and sell US dollars at 1.0989, which is the ask price in the market, and we would need to take those dollars and sell Canadian at 1.3632. We can therefore buy 1.0989 US dollars at 1.0989 into 1.3632 to give us a rate of 1.4980. In order to cover our shorts, our euro short, we would need to buy at 1.4980, and therefore the ask rate would be higher than this rate, 1.4980, and the 1.4980 becomes the floor. If we sell below the floor, it would be difficult for us to make any money from this deal. So now we've constructed the bid and ask rate. Our bid rate would be lower or equal to the rate at which we can construct a sale, which is 1.4975, and your ask rate would be higher than the rate at which you could construct your buy, which is 1.4980. And you could quote anywhere between 1.4973 to 82 for a cross rate. So this illustration shows us how we can construct a cross rate from the bid and ask prices in the market. Now, if you see the spread in the price 1.4973 and 82, that's a massive spread of 9 pips, which no one would make a trade on. So if you quote this in the market, the price taker would walk away and no one would hit you on that price. We will look at how price makers actually quote in the markets by trending the prices and based on views. But the focus here is that we get familiar with the bid, the ask, and the bid-ask spreads, and on which side to hit the price maker, or if you are the price maker, on how to quote the prices